This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Alright, I'm going to go through the paper F9 exam from December 2014. And first of all, we'll go through the multiple choice questions in section A. But just one or 2 points before I do as far as technique's concerned. I'll go through them in order, then there's no confusion. But do appreciate that in this exam and in all F9 exams, the multiple choice questions, some of them are relatively short, hopefully relatively easy and very fast. Others inevitably take a fair bit longer, either because there's a lot to read or because there are calculations involved. But the point is they all carry 2 marks, even though, when the examiner says this will always be the case, even though some of them are much quicker and easier, some of them are much harder and longer. And so, although, as I said, I'll go through them in order, certainly in the when you're doing the exam, do watch yourself. You know, your aim is to get at least 50% on every part of the paper. The way to approach the multiple choice is, all right, start at number 1 and start working through. But as soon as you come to something which is taking a long time to read, or obviously you'll need a lot of arithmetic, or is on a topic that you know that you don't know much about, then jump over it. You want to get through it as fast as you can. Look for the short questions, the easy questions, get the marks, and hopefully, after that first run through, you'll have got 7, 8, 9 of them correct. You'll still hopefully have plenty of time left for section A. Then you can go back and you can spend longer on, again, those that you find harder or there's more to read. But do look for the quick ones. You know, some of them, I say I'm going to go through them all, obviously, but question 2, for instance, is a very short one. If you know the answer, obviously answer it. If you don't know the answer, then guess. It's pointless to keep staring at it. And there's no negative marking. If you get 1 right, it's 2 marks. If you get it wrong, it's 0. Full stop. For the numbers ones, I'll try and show the workings neatly, then you can follow them. Don't waste time in the exam. Nobody looks at your workings at all. So don't want it being pretty for section A. And finally, do make sure you fill in the answer sheet. You'll be given a sheet. It'll have all the questions listed, or the numbers listed. There'll be 4 blobs, A, B, C, D. When you've got the answer, if the answer to question 1 is A, you fill in the blob. If the question answer to number 2 is B, you fill in the blob. But you must fill in the blobs. Apparently people hand in just in the answer book, they just write down answers. Well, that's not good enough. You've got to fill in the blobs. If you make a mistake, you put a cross through it and tick the right one. The only problem there, of course, is if you later look back and decide, the answer was A after all. Well, you can't go back. So you can change your answer, but you can't go back to one you've already crossed out. And so if you're unsure, write on the question paper. You're allowed to write on the question paper. Perhaps when you're going through number 1, you're not sure if it's A or B. Write it on the question paper, but make sure nobody will look at the question paper afterwards. So make sure before the time's up that you have gone back to question 1. Either decided, it is A, it is B. Or if you're still not sure, make a guess. You must answer 20 questions. You know, even if 5 of them are guesses because you ran out of time or you couldn't do them. But with 5 guesses, you're almost certain to get at least 1 of them right. And it may only be 2 marks, but if you're failing on 49%, 2 marks is a lot. Very last of all, you've got the 15 minutes reading and preparation time. By all means, I mean, I actually would look at section B, look at the requirements, just so that I can decide, perhaps what order to do the questions in. But anytime you spend on section A, by all means, start working through the questions. You can write workings and answers on the question paper. You can only start filling in the sheet when the 15 minutes is up. And so if you have done anything on the question paper, make sure you copy it onto the answer sheet. All right, so all that was just introduction. We'll start actually going through the questions. Make sure you've got the question paper in front of you, obviously. So let's go through them in order. First of all, question 1. Always look at the requirement first, otherwise there's a danger of wasting time reading the information, not knowing where you're going. It wants to know what is the current share price. Now, if you look back, it says TKQ has just paid a dividend of 21 cents a share. Its share price 1 year ago was $3.10. The total shareholder return for the year is 19.7%. Well, the total shareholder return for the year is the dividend they've had plus the increase in share price expressed as a percentage of the share price at the beginning of the year. We know what the share price at the beginning of the year was. It was $3.10. They're getting a return over the year of 19.7%. And so the total they'll have had over the year, 19.7% of $3.10 is 0.6107. That's the total return they'll have had. Well, they've just had a dividend of 21 cents. And so the remainder of the 61 cents, the remainder of 0.4007, that must be the increase in the share price. So the total return they've had, share price has gone up by 40 cents. They've had a dividend of 21 cents, a total of 61 cents, which is 19.7%. The share price has gone up by 40 cents, obviously from the choice of answers, it's to the nearest cent. It was $3.10 a year ago. It's gone up by 40 cents. And so the current share price must be $3.50. The answer is A. So hopefully that was a nice start. Let's carry on. Number 2. Which of the following statements are correct? I was saying earlier, this is the sort of question where I know for a lot of you, English may be your second, third language, so it may take that bit longer to read. But apart from the time it takes to read, it's a fairly short question. And it's one of those where you either know the answer, tick it, or you don't know the answer, guess. Let's read through them. Securitization is the conversion of illiquid assets into marketable securities. Yes. I can't give a full lecture here on everything. I mean, look at the lectures on the website. But the sort of thing is, it's like a bank. A bank may have lots of different people owing them money. They can effectively sell those debts by putting them all together, issuing bonds or shares based on those. They're turning it into a marketable security. Number 2, the reverse yield gap refers to equity yields being higher than debt yields. No, it's the other way around. Number 3, in fact, use a bit of sense here, although I'm going to answer it. Look at the choices. Since the answer to 2 is no, it can't be A, it can't be C, it can't be D. The answer has to be B. What is 3 though? Disintermediarization arises when borrowers deal directly with lending individuals. Yes. You see, more commonly, People with money are putting money in the bank, and then the bank is lending it to borrowers. The bank's acting as an intermediary. Disintermediarisation, it means we cut out the bank. If you've got money to lend, instead of putting it in the bank, you lend it straight to borrowers. So it's 1 and 3. The answer is B. And bear in mind what I said. As you're reading through the 3, if any of them you're not sure about, or you don't quite understand, well, if you can get any 2 of them right, not always, but most often, if you can get 2 of them right, automatically it's only one of the 4 choices. Number 3. Another, which of the following statements is correct? Number 1, maximising market share is an example of a financial objective. No, certainly it's an objective, but it's non-financial. Financial objectives are actually looking at things like profits and that sort of thing. 2, shareholder wealth maximisation is the primary financial objective for a company listed on the stock exchange. Yes, it's financial, the share price, and the main objective of any listed company is to try and increase the share price. Number 3, and again actually, just like before, I think I'm right in saying, yes I am, once you've decided number 1 isn't financial, there's only one answer left that works, but still. Number 3, financial objectives should be quantitative, so their achievement can be measured. Quantitative, they've got to be objectives so we can actually put a number to, so we can actually say, you know, the number's better than last year or it's worse than last year. The answer is yes. So the answer is 2 and 3, C. And I'm sorry repeating what I said before, but do keep your eye on the choices of answer, because you are going to be under enormous time pressure. And if it's obvious after looking at statements 1 and 2, if it's obvious the answer's going to be C, don't waste time. Every second counts. It gives you more time later on. Okay, number 4. Here's a calculation one. Working to the nearest $100, what is the 6-month dollar value of the expected receipt using a money market hedge? Our home currency is the dollar. We're going to receive 500,000 pesos in 6 months' time. We told the spot rate, the forward rate, and the interest rates for both borrowing and depositing. Well, I'm not going to give a whole lecture on money market hedging. There's a full lecture on the website. But let's run through the 3 steps. First of all, since we're going to be receiving pesos, to be able to convert now at the current spot rate, we'll borrow pesos now for 6 months. The interest rate, well, pesos is the foreign country, so the interest we'll have to pay on the borrowing. The borrowing interest in the foreign country is 8% a year. We're only borrowing for 6 months, so it's 6/12, half a year. We'll be paying interest of 4%. Remember, we want to make sure the amount we borrow, that in 6 months' time, the 500,000 pesos will repay the borrowing together with interest. And so the amount we'll borrow, 500,000 divided by 1 plus the interest rate. Which is 480,769 pesos that we'll borrow now. I said I wasn't going to give a full lecture, but if you borrow 480,000 now, in 6 months' time you'll add on 4%. You'll be owing 500,000. The receipt from the customer would exactly repay the borrowing. The reason we borrow now is we're now able to convert now at spot rate. And so with 480,769, the spot rate, there are 15 pesos to the dollar. So to convert to dollars, divide by 15, and it gives us 480,769 divided by 15, 32051. It's that many dollars now. However, finally, instead of taking the dollars now, we wait 6 months, which is when the receipt would have come in, and so we deposit the dollars for 6 months. We'll earn interest. And the interest, well, the deposit interest rate in the home country, which is dollars, is 3% per year. We're only depositing for half a year, and so we'll earn interest of 1.5%. And so how much will our deposit have grown to? It was 32,051. Multiply by 1 plus R, the interest rate, to add on the interest. And in 6 months' time, it'll have grown to 32,532. It'll be fixed at that in 6 months' time. What did it say? We're working to the nearest 100. What's the 6-month dollar value of the expected receipts? Well, to the nearest 100, 32,500. The answer is A. So, I said before, some of these very quick, some longer. This is a longer one, although I appreciate it took me longer because I was talking and I was trying to set it out reasonably neatly. By the time of the exam, that should be something you can do very quickly indeed, even though it's still going to take longer than the previous couple. Next one, number 5, another statement one. Which of the following statements is correct? A bonus issue can be used to raise new finance. No. You should know right back from paper F3, a bonus issue, it's free shares. We don't actually raise any finance. B, a share repurchase scheme can increase both earnings per share and gearing. Yes, if a company buys back shares, there are then fewer shares in issue. And if you think about it, if you have fewer shares in issue, the earnings per share, if you divide it by fewer shares, it'll go up. As far as gearing is concerned, gearing is the proportion of debt finance in the business. Well, if you've bought back shares, equity is lower, debt remains the same, and so the gearing would go up. In fact, it's not necessarily, for reasons I'm not going to go into, but certainly the question says it can increase both earnings per share and gearing. Well, the answer is yes. As I was saying earlier, you are under time pressure, so if you're confident of B, go for it. Don't waste time, but let's check the other two. C. Modigliani Miller argued that the financing decision is more important than the dividends decision. There's an element of truth there, although remember, certainly in the absence of tax, the financing decision is irrelevant. In the absence of tax, it makes no difference how they raise money. And so that wasn't completely true. D, shares have the power to increase dividends. He's trying to trick you slightly. No, shareholders will vote on the dividends, but they can't simply increase them at the meeting. So the answer is B. Okay, number 6. Yet another statement one. Which of the following statements is correct? Tax allowable depreciation is a relevant cash flow when evaluating borrowing to buy compared to leasing as a financing choice. No. The tax allowable depreciation, or capital allowances, it's never ever a relevant cash flow. Whereas the wording may have confused you. It's fine. We may need to take it into account to calculate the tax saving on capital allowances or on tax liable depreciation. But that's different. The tax saving is a relevant cash flow. The depreciation itself is not a cash flow. It is never relevant. Asset replacement decisions require relevant cash flows to be discounted. So far, true. But discounted by the after-tax cost of debt? No. We discount at the weighted average cost of capital, not at the after-tax cost of debt alone. C, if capital is rationed, divisible investment projects can be ranked by the profitability index when determining the optimum investment schedules. Yes. If you've not watch the lectures on capital rationing to decide which order they're worth the best done in, the ranking. We look at the net present value of the project per dollar invested. Finally, D, government restrictions on bank lending are associated with soft capital rationing. No, that would be hard capital rationing. Hard capital rationing is when we can't borrow anymore. Soft capital rationing is when we can borrow more, but we choose not to. We set our own limit. Number 7. An investment project has a cost of $12,000 payable at the start of the first year of operation. The possible future cash flows arising from the investment project have the following present values and associated probabilities. Well, there's more than one way you can get the same answer. It's up to you. I'll do it a slightly different way than the examiner did. But it is expected values, clearly, which is something you've already been examined on in paper F5. But the present value at time 1, or the expected present value, it's either 16,000, 12,000 or minus 4,000. Probabilities 0.15, 0.6, 0.25. The expected present value multiplied by the probabilities and add up. 16,000 times 0.15 is 2,400, I hope. Yep. 12,000 times 0.6 is 7,200. 4,000 times 0.25 is 1,000. It's negative. So the expected present value, 8,600. That was the year 1 present values. The year 2 expected present value, it's either 20,000 or minus 2,000 with probabilities 0.75, 0.25. So again, for the expected present value, multiply by the probabilities and add up. 20 times 0.75 is 15. 2 times 0.25 is 500. It's negative. And so 14,500. And so the expected net present value, well, there's an outflow of 12,000 at time 0, the original cost, an expected inflow of 86 at time 1, and of 14,500 at time 2, which gives me an expected value of I think 11,100. The answer is C. Now, I don't know, the alternative way, we can look at the way the examiner's done it in his answer. I don't know. I think the way I've done it there is both easier and faster, but that's entirely your choice. Number 8, back to statements. Which of the following statements is correct? A little bit confusing perhaps, but A, once purchased, currency futures have a range of closeout dates. It's a slight twist on terminology there. I'm not too happy about that, because you can finish the future whenever you want, but futures themselves, standardly, there are 4 standard finishing dates. It's the quarter days: end of March, end of June, end of September, end of December. And once you bought it, if you bought a March future, then that has to finish at the end of March. If you bought a June future, it has to finish at the end of June. So I don't quite like his wording. I'd want to carry on and read the others, to be honest, before I was certain. The answer, in fact, isn't A. B, currency swaps can be used to hedge exchange rates over a longer periods than the forward market. Yes, I mean, although you can have over-the-counter forward rates standardly are over reasonably short periods, generally in months, whereas a currency swap, they tend to be used for long-term borrowings. They don't want to borrow in dollars, somebody else wants to borrow in pounds. We swap and pay each other's interest. They tend to be over longer periods. So B is in fact correct. C, no question, definitely wrong. They will allow forward exchange contracts to lapse if they're not used by a company. No, if you've gone for a forward rate, you have to convert at that forward rate. You've no choice. You can't not use it. That would be an option. Finally, D, currency options are paid for when they're exercised. No, currency options, you pay for the option, but you pay for it immediately. I might want the option to convert money at a fixed rate in 6 months' time. Although I'll exercise or not exercise in 6 months, I have to pay the premium now, immediately, not when it's exercised. So the answer is B. Number 9. Now, a lot of people get this wrong, and learn from this and be clear. And if you need, again, watch the lecture. I go through this in detail in the lecture on valuation of securities. It says, what's the current market value of each loan note? We've got 7% loan notes in issue, which are redeemable in 7 years' time, at a 5% premium to their nominal value of $100. The before-tax cost of debt is 9%. The after-tax cost of debt is 6%. I'm not going to write down, but listen. The market value of debt is fixed by the investors. And the way they calculate market value, it's the present value of the future receipts they're going to get, discounted at their required return. What are the future receipts going to be? On $100 nominal, they're going to receive interest each year. It'll be interest for 7 years. For 7 years, it's redeemed in 7 years' time. The interest is 7%. That's the coupon rate. It's $7. 7% of nominal, and so $7. Tax there is irrelevant. As far as the investor's concerned, they'll receive $7. In 7 years' time, these will be repaid or redeemed. It says they're redeemed in 7 years' time at a 5% premium on the nominal value. So on the nominal of 100, 5% premium will be repaid 105. So those are the receipts the investors are expecting. The market value we discount at the investor's required return. And the investor's required return is the pre-tax 9%. All right, the cost to the company is lower, but that's completely irrelevant here. It's the investors who fix the market value. So it's then pure discounting. So the finishing off shouldn't be a problem. Interest, 7 years at 9%. The 7-year annuity factor at 9% is 5.033. The redemption, the ordinary factor, 7 years at 9%. It's 0.5, I'm on the right line, 0.547. And so the present values, 35.231, 57.435, so the market value for $100 nominal at 92.666 PC per 100. The correct answer is A. Next one, got our tables in the wrong place now. Number 10, yet another statement one. Half the exam will be a combination of the statement ones in section A and written parts in section B, which I'm going to go through later. Don't rely just on numbers. Which of the following statements concerning working capital management are correct? Number 1, working capital should increase as sales increase. Yes, working capital, we're talking about our receivables, our inventories, our payables. Well, as you sell more and more, you will expect more receivables. As you sell more and more, you will presumably be producing more. You'll need more inventory and so on. So working capital should increase as sales increase. Number 2, an increase in the operating cycle will decrease profitability. Yes. But the operating cycle, remember, is the number of days that cash is tied up in inventories, in receivables. Higher sales certainly will mean more inventory, more receivables and so on, but that shouldn't mean that cash is tied up any longer. The longer cash is tied up, the more it's costing us money. Things like lost interest and so on. It will decrease profitability. Question 3, well, it's just a fact. I mean, you've got to have been through this. Again, there are lectures on all of this. But overtrading is also known as undercapitalization. Yes. You're expanding rapidly. Working capital isn't going up, as it should do. You run out of cash. You're not capitalized enough. Anyway, it's all 3. The answer is D.